Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. No surprises. Well, the economy and financial markets are usually full of surprises. For example, everyone was bearish at the beginning of the year, expecting a recession and further weakness in the stock market. And what has happened? The economy has proved resilient and the stock market has been moving steadily higher with a gain of more than 15% for the S&P 500 index in the first half of the year. Now, more recently, however, market volatility has plummeted and everything seems to be going according to plan. We seem to be in a Goldilocks environment at the moment where everything is just right. Earnings reports have been meeting or beating expectations, and the Federal Reserve didn't provide any surprises this past week with another quarter-point interest rate hike that was right in line with everyone's expectations. Now, after a long enough period of no surprises, investors start to become complacent and forget about the risks inherent in markets. We might be getting close to the point where the market could be vulnerable if anything unexpected comes along to change the status quo. For this week's featured insight, dollar cost averaging. Well, now that the stock market has delivered an impressive return already in 2023, even though it still has a ways to go before reclaiming its all-time high reached in early 2022, investors may be worried that they could have missed out if they've been sitting in cash and playing it safe while the market has been on the rise. One strategy for getting money invested in stocks while also reducing the risk of a downturn in equity markets is to dollar cost average your money into the market over a period of time. Now, let's say that you have $50,000 to invest. Instead of investing it all at once, you could invest $10,000 a month for the next 5 months. Or if you want to spread it out even further, $5,000 a month for the next 10 months. That way, if the market continues higher, you would be participating in future gains along the way. But if the market moves lower, you'll have an opportunity to buy more shares with the same amount of money at lower prices. Looking ahead, Apple to report earnings. Well, Apple is arguably the most successful company of all time. At more than $3 trillion in market value, it's certainly the most highly valued company that has ever existed. I'm not sure that's true on an inflation-adjusted basis, but it probably is. Due to the ubiquitous nature of Apple's products, as well as the impressive historical performance of the stock, Apple is certainly a favorite holding in many investors' portfolios. I routinely review prospective clients' portfolios that hold as much as 15, 20, or even 25% or more of their total assets in just Apple stock alone. Now, this obviously has helped their total returns, given that Apple's up more than 100% in the past 3 years, 300% in the past 5 years, and more than 1,000% in the last 10 years. However, I always caution investors not to keep too many eggs in any one basket, even if it's a basket that's as seemingly secure and attractive as that of Apple's. The future is always uncertain, and there are plenty of examples of companies that reach the pinnacle of American business before seeing their businesses and stock prices deteriorate. With that being said, Apple is reporting earnings next week and should likely continue to impress investors with its financial performance. Nevertheless, expectations are high when you're king of the hill, and any disappointments will likely be met with substantial downside in the near term. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.